Hello, my name is Julie Hall. I am the Director of the Health Programs for the North Carolina League of Municipalities, and we're here to answer your insurance questions. And today we're going to talk a little bit about different options that will help you to manage your budgets. Everyone's medical insurance budgets are one of the biggest budget items, and we just want you to know that there are different ways to create unique plans that can help you manage this a little bit better. As you all know, the League does offer 20 standard plans to our smaller insureds. That would be any group that has less than 50 employees. And this has grown. I've been with the program for over 20 years now. When I first started with the plan, we actually only had 5 to choose from, and all groups, no matter what size you were, just picked one plan, and that's what you're in, and everybody had the same rate. So through the years, this has changed a lot. Our groups that have more than 50 employees actually can create whatever plan they would like to. They can design it any way they want, whatever fits their needs, or they can offer more than one plan. They can choose to offer what they can afford and have buy-up plans for their employees or buy-down plans. And then we also offer our dental, vision, life, and disability plans. And with our dental and our vision plans, the same is true for all size groups, from one employee all the way up to our biggest employer. They can offer more than one dental or vision plan so that their employees can buy up or down to whatever their needs are for their families. So one of the options that we have is our self-funded plans. Our pool is a self-funded pool, but we also can do self-funded plans for our very large members if they're interested. So what would be a good size for being self-funded? We typically would not want to do this for anyone that's smaller than 250. There are groups out there that have been successful that have done even less than 100 employees, but it is one of those little risk takers that would it be safe to do it or not? Just a few things that you would need to consider. So when you leave the safety of a fully insured plan, you're not going to have that same premium every single month with a predictable cash flow, which we all enjoy. When you're self-funded, all of the risk is going to shift to the employer. Suddenly things that you never thought about, like Susie next to you is getting a hip replaced or somebody falls out sick, all these things are going to be stresses to you now going forward because they are going to actually be your costs. So do you need predictability, or can your budget handle a little bit of volatility with your employees' health insurance claims? So how many people actually do hit a deductible each year? When you look at a group of 100%, usually less than 20% will actually hit the deductible. But when they hit it, they can hit it pretty hard. Some of the claims that you will see out there, these are some of the most common ones that we picked out from the MIT Health Pool that we see go through on a weekly basis. And keep in mind when you're looking at the cost of these different surgeries and procedures, these are procedures and surgeries that went very well. And this is not all the pre-treatment and the after-treatment. So if you get a hip or knee replacement, of course, you're going to be going back to the doctors numerous times afterwards. So these costs can escalate very quickly. And if any of these were to go bad, they can be a multi-million-dollar claim quickly. One of our biggest claims we ever had was twins that did not go well. And you just have to keep in mind that these are some costs and how much of them can you afford on a budget to pay for. So one of the things you're going to need to go shopping for if you're going to become self-funded is stop-loss insurance. Stop-loss insurance will protect you against those catastrophic claims that you may or may not have. So you're going to have to sit down and decide, of that catastrophic multi-million-dollar claim, can I afford $50,000, $75,000, $100,000, $350,000? The bigger that number goes, of course, the less expensive the stop-loss insurance is going to be. So you have to kind of squeeze the balloon and decide how much of the claim can we afford to cover, and how much can we pay each month for the stop-loss insurance. So if you're not quite ready to go self-funded completely, we do have a hybrid approach that you could try. We do have our medical expense reimbursement plan, and we do actually currently have several of our cities that are on this plan, and they enjoy it a lot. It gives you a little taste of self-funding, and it may be, if you're looking at going full self-funded, the way that you start out, just to test it a little bit. You would set up a medical expense reimbursement or an HRA, some people know more like that, where it would be employer's money put into a bank account. And what you're going to do is you would take a very large deductible, and you would have everything else with a regular PPO plan. You'd have your copays and everything in place, but you could take a $5,000 up to $10,000 deductible, and you would sit down with me or somebody else from our staff, and we would decide what portion you're going to have the employee pay of the deductible and the coinsurance, and you would share this with them. So you set up a medical expense reimbursement, you put the savings that you're going to have the first year into this account, and you only pull out money for those that meet the deductible. Now, I mentioned before in the self-funded plan that usually less than 20% of your employees actually ever hit the deductible. And it's even a smaller amount that hit the full amount of the deductible, especially when you're talking about a deductible that big. So whenever somebody does hit that deductible, you would pull money out and just pay for that. And MedCost actually does have a medical expense reimbursement plan that makes it so the employer doesn't have to be involved at all. So if you're interested in that, they offer one, and there are other groups out there that offer that as well, where it happens automatic when the claim is filed. It pulls from the account the portion that would be the employer's part, and then the portion that is the employee's part is billed to the employee at home. So this is something that takes it's got a lot of different moving pieces. This is something we'd want to come out and sit down and design the plan and make some good decisions, and you'd probably want us to come on site and do this with you. But it is an approach that you can take if you're not quite ready to go fully self-funded, but you're looking at just dipping your toe into it just a little bit. Now let's take a look at our qualified high deductible health plans with health savings accounts that the league offers, and also the medical supplement plan if you're not quite ready to go to a full high deductible health plan with an HSA. High deductible health plans. This is a plan that none of us have looked at for a long time because, quite honestly, when they came out 10 or 11 years ago, they were just quite scary. And they've made a lot of changes to these plans with healthcare reform, and they actually have become a very good benefit for our employees. And for those of us that are trying to attract the much younger employees, they are looking at this as their medical retirement plan. So this is something that I think we all need to take a look at once again, because most of the younger generation aren't planning on working 20 to 30 years at one employer and retiring with medical benefits. They're looking at having these types of health savings accounts that you can attach to a true qualified high deductible health plan. So some of the misconceptions or myths that are around these plans. Previously, when you had a true qualified high deductible health plan, there was never any copays allowed within this plan. Now, as you can see within the first bubble, for a high deductible health plan, they allow pharmacy copays after the deductible piece is met. So this is one of the great changes that came along with healthcare reform. Also, with high deductible health plans, the preventative medications are covered at 100% from the very beginning. You do not have to meet the deductible for anything like cholesterol medication, high blood pressure, birth control. Plus, all of your wellness is also covered at 100%, so you never have to meet any of the deductible with that at all. So here's a sample plan design of how rich these plans can actually be. So what I have done is I've gone and take the lowest qualified deductible that you can put in place for your employees and their families to give you an idea of how rich of a benefit this can be. So basically what we've had is your deductible is $1,350. But remember, the yellow square box at the bottom should actually be at the top because your wellness and your preventative medication is covered at 100% from the very beginning. But when we're looking at a true qualified high deductible health plan, the first thing you need to know about that is the deductible. Everything goes toward the deductible except for those preventative medications and wellness. So you have to meet that first corridor before you get into coinsurance for your plan, which for this example, I've set up as 80-20. So the plan pays 80% and the member would pay 20%. So this is, as you can see, is a very rich plan. After you get through that first deductible, the $1,350, you then have a coinsurance for all your doctor's appointments, a share of 80-20, plus you get co-payments put in place for your pharmacy. And this is an example of what those co-payments could look like. And this is something we would sit down with you and decide what type of plan design you would want to have. Now your max amount of pocket, once you hit that, the $3,000, everything pays at 100% for the rest of the year. So as you can see, most of us do not have this rich of a plan in place already. So this is a good example of how rich these plans can be and what a benefit they can be for your employee. Now let's take it one step further, because when you have a qualified high deductible health plan, one thing you can do with a qualified plan is put a health savings account attached to it. Now this money would be your employee's money, and you would put it in a savings account for them, their own bank account, and they would have a debit card that they would use to pay for their expenses. So once again, we look at this account, this plan design that we've set up. Your deductible is $1,350, which is the lowest you can go. And your health savings account you put in place is $1,000. Now for the first year, we'd recommend you put the full $1,000 in up front. But as I said, this money will be your employees. So years after that, you might want to split it up throughout the year. Maybe the first half in the first part of the year, the second half mid-year. Or some cities and towns, I've seen them put it in monthly, as a monthly amount that goes into the savings account. But once it's deposited, you have to remember that this is the employee. So if you have a high turnover, you may want to consider having it spread out throughout the year. So really, if you look at this plan, you really only have a $350 deductible if this individual decided to use their health savings account money, which is a super rich plan. I don't think anybody has that low of a deductible now. And then it's the same as before. The wellness and the preventive medications would be paid at 100% at the very beginning. And then after you meet that deductible fully of $1,350, you would have a sharing with the plan of 80-20. And your copays would also turn on for your pharmacy. And we've given an example of how they could be set up. So really, when you look at this plan, the true out-of-pocket maximum is only $2,000. So once again, it's a very rich plan. Now, how high can we go with those deductibles? So for a maximum for an individual, it's $6,650, and these are 2018 numbers. For family, it's $13,300. Now, if you set your deductibles at those maximum, you will notice that these are the same maximums for your out-of-pocket expenses per the healthcare reform guidelines. So for 2018, no individual is allowed to pay more than these two numbers that are listed. So if you do choose these amounts as your deductible, there would be no coinsurance or pharmacy copays. Everything would pay 100% after you hit that maximum deductible. And then as you can see, the minimum deductible is $1,350 for individual and $2,700 for family. Now for your health savings accounts, I had mentioned that you can have a health savings account attached to a qualified plan. The minimum and maximums for your health savings account is, for a maximum for individual, is $3,450 for individual and $6,900 for family. These accounts have a triple tax benefit. So they're a portable account. They are the employees, as I mentioned before. So once you put the money in there, it's theirs. When they leave your employment, they take the money with them. The only key factor to this is you cannot contribute to this plan unless you have a qualified high deductible health plan. You can still spend the money that's in the account. So the employee could still use all of that money on his family members and himself or herself. They just would not be able to contribute unless they moved to a new employer that had a qualified high deductible health plan. And then they would just roll it over to that employer and be able to contribute. So it is portable. You contribute to a pre-tax, it grows tax-free, and it can be spent tax-free. Now, if you are over age 55, you can contribute $1,000 more to this account than what is listed on each annual year. So each year they come out with a new maximum that you can contribute. But if you are over age 55, you can contribute $1,000 more. It's a catch-up amount. The high deductible health plans, they give your employees increased control over their health care, decision-making, and spending. So what's going to happen is consumerism is going to kick in. No longer is anyone going to just schedule an MRI. They're going to consider the cost of the MRI. We would provide all the tools for this online, so they can go out and price any of these pre-scheduled procedures, MRIs, if you're having a hip replacement or any of these types of surgeries that are pre-planned. Of course, not your emergency situations, but pre-planned surgeries for sure. Also, with your medications, people are no longer going to go and just take the prescription from the doctor and go to whatever pharmacy they want to. One, they're going to ask the doctor what is the least expensive medication they can be on. And they're probably not going to take those drug samples that are handed out in the doctor's office, because these, as we know, are not the generics of the world. They're usually the most expensive drug that's out there currently. So they're going to ask the doctor and have that conversation on what is the least expensive I can take. And they're going to go online. Our vendor that we use is OptumRx, and they're going to price out how much it is at Walgreens and CVS and Walmart and do a comparison, because each of these places are going to have their own personal contract, and the price is going to vary very much between each one. So they're going to start making consumer-driven decisions on how they're going to spend their money. And in the long run, that is where you actually save the money when you move to high deductible health plan, is getting the consumerism piece in place. So if you're not quite ready to go completely to the high deductible health plan, but you like the idea of having a high deductible just so you can have the savings on the premium, we do have another option in place as well, our supplemental insurance. So with our supplemental insurance, or as many of you are probably familiar with, a gap plan, you basically are going to take a high deductible health plan, but it's not going to be a qualified high deductible health plan. So there will be no health savings account. You will have a very high deductible of $2,000, $3,000, $5,000. I've seen them as high as $10,000. So you have the savings on that, and then you buy a little overlay of a gap plan. Now the gap plan basically takes your deductible and puts it into two different buckets. One inpatient and one outpatient. So basically your employees are going to have two cards. They're going to have their major medical card and then their gap plan card. And the supplemental plan only is going to cover for anything that is hitting your deductible. It doesn't pay for any of the co-pays or anything like that. But it does have a consumerism piece in it. So how it's going to work is you would set it up two buckets, one for inpatient. And for inpatient, if somebody is inpatient, they basically probably did not plan on being there. It's something bad has happened, or they're having babies. It's something that they could not shop. There's no consumerism type thing that you're going to put in place for any inpatient. So you could even cover that as much as 100% with the gap plan. The outpatient is where the consumerism piece is going to kick in, because you're going to have those planned surgeries. You're going to have those big expensive scans like the MRI, and these go toward your deductible. But the employee, so what you would want to do is split that probably 50-50 with them. So part of the deductible is theirs, and part of it would be the gap plan. So the gap plan would be the first portion, and how we get them to use the consumerism piece is they are not going to want to get to the portion they're going to have to pay for. So they're going to go online, they're going to see how much the MRI is, where it's going to be cheapest, which, as we know, if it's in the hospital, it's going to be 3 times more expensive than it would be in a freestanding facility. And they're going to choose the least expensive place to get the MRI done, because they don't want to get to the part that they're going to have to pay for. So that's where the consumerism kicks in on this. And if this is something you're interested in hearing more about, we can always come out and talk to you about any of these plans that we've described. They're all pretty unique and they all have a lot of moving pieces, and it's something that takes a lot of education. So any of these different plans that we've discussed today, if we did put them in place for your employees, you'd want at least 6 months ahead of time so that we can come out and educate the employees several times before they're actually activated.